Hi there, Andy here. Welcome to this latest video about how the city works. In today's video, we're going to take a look at the different types of banks and their roles within the financial system. There's effectively three main types of bank: retail, investment, and central banks. And today we'll take a quick look at each of them. Retail banks. Retail banks have been around as long as money itself, starting out with simple monetary lenders. They're set up to accept money on deposit from savers, paying out a rate of interest in return. At the same time, they then lend money out at different maturities and also at higher rates of interest than offered on the savings. So in principle, it's to pay out less on the deposits than they generate an income by lending out the same money. Size therefore matters. It's generally a low profit margin business, so you need a high volume of monetary flow to make decent money. But overall, it's a simple business model. Investment banks. These are generally higher risk and also higher return than retail banks. Lines have been blurred over time between retail and investment banks, and now there's a large number of banks doing both, for example Barclays or HSBC. But there are some that concentrate on investment banking, for example Goldman Sachs. The investment arm of the banks will be taking part in a few different activities. Proprietary trading, where they use the bank's monetary reserves to trade and take risk in the markets in the hope of making a return. Their size and information flow hopefully giving them statistical edge to win more often than they lose. New issues, where the bank charge a fee for helping advising companies to come to the market and raise capital. The advice could be around regulations, pricing, timing, investor contact, etc. Market making, where they provide liquidity to bid on the offer in the market. The bank will try and take some of the value from the bid-offer spread out of the market using electronic order books. For more unusual, less liquid assets, they may go through a broker. The bank will still be making markets on these less liquid assets. The more liquid, the wider bid-offer spread the bank will make, but they will help create a market. Corporate finance, mergers and acquisitions, where the bank could be advising either the buying corporate or the target company for a fee. Advice for the buyer may be price, timing, regulatory issues, etc. Advice for the target company might be defense tactics or price. Asset management solutions, where the bank may provide risk management solutions using derivatives to provide a solution for a client to maintain the risk-reward profile that client requires. Central banks. The role of the central bank is to achieve monetary stability through long-term stability of growth and employment. They normally have inflationary targets, for instance 2% for the Bank of England. They need to maintain confidence in the currency, so for the Bank of England that would be confidence in the pound sterling. The bank does this through policy tools such as interest rates and quantitative easing. So, interest rates. As the economy slows, growth rates slow down, GDP slows down and the economy contracts. This results in prices falling or stalling as people and businesses stop spending. Inflation measurement should then pick up the economy slowing down and the bank then subsequently lower interest rates. There's a time lag in the response of this action, however, but hopefully the cost of borrowing for consumers and businesses drops. Bank rates directly affect the rate that commercial banks charge to lend to each other. This in turn directly affects how much your mortgage costs and how much you earn interest on the savings and the rate at which companies can borrow capital. People and businesses then start to think it's a better time to invest in business as it's cheaper to borrow and expand. At the same time, you're getting less for holding money in the bank as the interest rate on your savings has dropped. So it feels like a better time to spend your money. As people and businesses then begin to spend, prices start to go up, which increases the rate of inflation once again. Banks then start to raise interest rates to dampen down demand by increasing the amount you pay to borrow money, but also by increasing the amount you earn by leaving the money in the bank. This in turn then dampens down the economy and the cycle continues. The trick is the time lag and managing to act just enough to maintain stability without having a damaging effect. Quantitative easing. Quantitative easing can be used as a supplementary measure to interest rates. Central banks effectively buys financial assets from existing holders using money it prints, resulting in money making its way back into the system. The bank buys bonds and other assets. The pension funds and insurers that the bank buys these bonds and other assets of then either deposit the money back in the banks, in theory boosting lending by the banks. However, in practice, the banks held on to the money to repair their balance sheet, so this didn't quite work as planned in theory. They might buy other debts or equities, which in turn boosts borrowing and spending and boosts asset prices. For example, the Bank of England bought mainly gilts, the aim being to push up the price of the gilts, which in turn lowered yields. People who held the gilts didn't want to hold on to low yields, so they switched into other corporate bonds and shares, which in turn hopefully pushes up the prices of other assets, supports new issuances, lowers borrowing costs for consumers as the yield on the government bond, the gilts, is directly linked to the price you pay for your mortgage or your loan. This all resulted in asset price inflation, equity inflation and property inflation. Central banks do have some other roles as well, including maintaining the supply and security of banknotes. The Bank of England have been the main issuer of banknotes for over 300 years and are responsible for the design, the distribution and the withdrawal of banknotes. The regulation of banks, building societies, insurers and investment firms, so making sure that there's an effective competition and a fair deal for consumers. They supervise banking settlement systems, central counterparties and also payment systems. The Bank of England also has its own governor and its own board. It is in theory free to make its own decisions separate from government and the Treasury. Its current mission statement is to promote the good of the people of the United Kingdom by maintaining monetary and fiscal stability. If you found today's video useful, please subscribe. I'll be back soon with more learnings, so see you next time. Until then, good luck.